How and when to buy stocks. Should you hire an expert or invest on your own? Investing in the stock market is one of the most effective ways to build wealth over time, but making the right decisions requires knowledge, strategy, and discipline. One of the biggest questions new investors face is when to buy stocks and whether to hire an expert or manage their investments independently. This article breaks down the best times to buy stocks, key investment strategies, and the pros and cons of professional stock management versus DIY investing. When to buy stocks. Timing the stock market perfectly is nearly impossible, but several strategies can increase your chances of buying stocks at the right time. 1. During market corrections and bear markets. A market correction occurs when stock prices drop 10% or more from recent highs, while a bear market is when prices drop 20% or more over a prolonged period. While these downturns can be nerve-wracking, they often present great opportunities to buy strong companies at a discount. For example, in 2020, during the COVID-19 crash, the S&P 500 fell nearly 34% in 1 month before rebounding to reach new highs. Investors who bought during the downturn saw significant returns within a year. 2. Buy stocks of companies with strong fundamentals. Before purchasing a stock, evaluate the company's fundamentals using key metrics, such as the price-to-earnings (P/E) ratio. A low P/E ratio compared to competitors can indicate an undervalued stock, revenue, and earnings growth. Companies with consistent year-over-year growth tend to perform well in the long run. Debt levels. A high debt-to-equity ratio can indicate financial instability. Competitive advantage. Look for businesses with strong brand loyalty, patents, or unique products. Example: Apple, APL, and Amazon, AMZN, have maintained strong fundamentals over decades, making them solid long-term investments. 3. Use dollar-cost averaging. DCA, to reduce risk. Instead of trying to buy stocks at the perfect time, dollar-cost averaging, DCA, involves investing a fixed amount at regular intervals, weekly or monthly. This strategy helps smooth out market volatility. Example: if you invest $500 per month in an S&P 500 index fund, you buy more shares when prices are low and fewer shares when prices are high. Over time, this reduces the risk of making a single large investment at a peak price. 4. Pay attention to economic and market indicators. Certain economic conditions can influence stock prices. Consider these factors. Interest rates. When interest rates rise, borrowing becomes more expensive, which can slow corporate growth. When they fall, stocks often rise. Inflation. High inflation can erode profits, leading to lower stock prices. Unemployment and GDP growth. A strong economy with low unemployment and rising GDP often leads to a bullish stock market. Example: in 2022, the Federal Reserve raised interest rates to combat inflation, causing tech stocks to decline. Investors who followed economic trends were able to adjust their portfolios accordingly. 5. Invest for the long term. Short-term market movements are unpredictable, but historically, the stock market has always recovered and grown over the long run. S&P 500 historical returns. Despite recessions and crashes, the S&P 500 has averaged around 10% annual returns over the past century. Avoid panic selling. Many investors sell during downturns, only to miss out on rebounds. Staying invested through market cycles is key. Example: someone who invested $10,000 in the S&P 500 in 1990 and left it untouched would have over $200,000 today. Due to compound growth. Should you hire a stock expert or invest on your own? Once you understand when and how to buy stocks, the next question is, should you manage your investments yourself or hire a financial expert? Option 1. Investing in your DIY investing. Many investors prefer to manage their portfolios. Here's why. Pros of DIY investing: lower costs. Financial advisors charge fees, typically 1% of assets under management, AUM, per year, which can eat into your returns. DIY investing eliminates these costs. More control. You decide which stocks to buy, sell, or hold. No middleman is involved. Learning experience. Managing your investments helps you understand markets, economic trends, and company valuations. Flexibility. You can act on market opportunities without waiting for a financial advisor's input. Cons of DIY investing. Time-consuming. Researching stocks, tracking market trends, and managing portfolios require time and effort. Emotional bias. Many investors panic during downturns and make impulsive decisions, leading to losses. Lack of expertise. Without proper knowledge, you may make poor investment choices. Best for investors who enjoy learning about stocks and finance. People are comfortable making their own decisions. Those with long-term investment strategies. Option 2. Hiring a stock expert or financial advisor. If you prefer a hands-off approach, hiring a financial expert can provide professional guidance. Here are the pros of hiring an expert. Professional expertise. Advisors analyze markets daily and can identify opportunities you might miss. Risk management. They can create a diversified portfolio based on your risk tolerance and financial goals. Emotional discipline. Advisors help prevent emotional reactions like panic selling. Retirement planning and tax strategies. Experts provide personalized strategies for wealth growth and minimizing tax liabilities. Here are the cons of hiring an expert. Fees can reduce returns. Many advisors charge 1% of AUM annually, which can add up. Potential conflicts of interest. Some advisors work on commission and may push products that benefit them more than you. Less control. You rely on someone else to manage your portfolio. This is best for busy professionals who don't have time to research stocks. High net worth individuals who need estate planning or tax-efficient strategies. Investors are prone to emotional decision-making during market volatility. Final verdict. Should you go solo or hire an expert? Go DIY if you're willing to learn, enjoy managing your own money, and want to avoid fees. Start with index funds or ETFs if you're new to investing. Hire an expert if you prefer hands-off investing, need advanced financial planning, or lack confidence in managing a portfolio. Here is a pro tip. Many investors use a hybrid approach, managing their portfolio while consulting an expert for major financial decisions. In conclusion, investing in stocks can be rewarding, but it requires strategy and patience. Whether you invest independently or hire an expert, the key to success is staying informed, diversifying your portfolio, and thinking long-term. Please give us a like and subscribe. Thanks for watching.